Hello, my name's Brad Scoffin with Advanced Business Advisors, and today we're doing a class on business brokerage. It's going to be an overview to business brokerage, should you choose to specialize in it or collaborate. What we're going to talk about today in this presentation of business brokering, the selling process of business entities, are what is business brokering, the challenges and some collaborative solutions, types of buyers and why that matters, understanding the needs of the seller and their goals, the process of selling a business, some of the pitfalls to be aware of and avoid, as those mistakes can be costly, and then address some typical questions and answers that we get when doing this presentation or working with others. As many of you have run into residential agents undermining the commercial industry, we too have seen those that dabble in business brokerage underserve their clients' needs. Basically, you don't know what you don't know. And today, the purpose is to give you an overview of business brokerage and give you access to resources should you choose to want to specialize in business brokering or collaborate with others to get the job done. I'm the current state president for the Michigan Business Brokers Association. My firm, Advanced Business Advisors, is founded by two partners, myself and my partner Larry, who has 30 years experience with business valuation. And we have a satellite office in California and service all of Michigan, Indiana, and Ohio with offices throughout. So today we're going to go through various topics. It's going to be an overview, but if you have questions at all, please feel free to reach out. We do a number of transactions throughout the year, and a vast majority of those are collaboration with other agents, both commercial agents and other business brokers. So happy to be a resource for you and sit down with you and talk about how we might be able to work together. So basically, what is business brokering and how does it compare to commercial real estate? It's a great place to start. Actually, there's a lot of similarities, but there are some great differences. In the similarities, both businesses are relationship driven and both require a great skill in deal making, negotiations, and getting the deal done. And conceptually, both channels require the ability to help a seller understand and predetermine the value and the set expectations on how you might go to market and what they can expect from the sell. Business transactions, however, have some vast differences, and this is where it gets complicated, and it's good to collaborate with somebody or have somebody that inside your firm that specializes. Business transactions are private, unlike in commercial real estate where there's things that are filed, deeds are filed, you can see past transactions. In the business world, it's all done privately, so there is no public records. Often, the need is to do the deals confidentially. And we'll talk more about that. But confidentiality is one of the key components that our business sellers are looking for. Also, unlike in real estate where the owner really doesn't matter, somebody's buying the piece of property or leasing the real estate, you're really positioning that on what they're going to look like in it. The owner does matter in a business transaction. You need to know how the business operated, what their skill set was, depending on the size of the transaction. So the owner is an integral part of information, the transfer of information to the buyer. Also, in this world, the sales cycle is quite longer. And that is where I was told when I first got into this business, there's really no barrier to entry. Anybody can be a business broker. Huge barriers to success because of that long sales cycle. Our sales cycle is often 2 to 4 years, and then usually it's 6 to 18 months from the point that it's listed, whereas real estate can be much faster than that. Obviously, there's a huge desire to look at business brokerage because the commissions are larger. Don't be fooled by that. The commissions are larger because often deals don't go through. Just because somebody brings it to market. In fact, the statistics are scary. 90% of all businesses that get listed don't sell in that year, and it's close to 70% of businesses that get listed never sell. They may go through liquidation later, but they actually don't sell. And there's a number of reasons for that. Lastly, the biggest difference with business brokerage is that selling a business is very emotional. It's somebody's baby. Blood, sweat, and tears put into it. They've worked on it for the last 30, 40 years, and there's a huge emotional component to that, and that can be something that makes there to be challenges in that arena. So let's talk about those challenges and what you might encounter. Usually, we get asked by people, what the value of their business are, and one of the biggest challenges is that we get to tell people that their baby is ugly. Everybody comes to me and asks, "What's my multiple?" And we always get or hear the number. I hear it's 3, and I always like to joke that yes, most business owners think they're worth 3 times what they're actually worth. So that is one of the biggest challenges in this industry: is setting the right expectations. Business owners need to understand what drives value, what a buyer will look at, and what the range they can expect. One of the other challenges is that most of them want to go fast. I mean, once they've got to the point that they want to, they're ready to sell, and they haven't been properly planning for that long sales cycle and how long it will actually take. Even if we find a buyer tomorrow, it still takes usually 3 to 6 months after that to get to close, just because of lawyers, bankers, and other items that come up in the deal. Most businesses are driven to this decision through a catalyst, which makes the timing of what they're deciding to do, not the right time. They haven't planned in advance. It's usually because there's a downturn in business, they're tired and they're just ready to give up, or there's been a health issue, whether their own, a spouse's, that's distracting them from the business. All of these things are usually past the peak of the business. The best time to sell a business is when it's on the upswing, not when it's downturned. Yet these are the time that when it's downturned is usually when they're looking to sell. And again, going through this with the business owner, selling a business is a process. There's a process in planning ahead, which is usually overlooked, but then there's a process in setting up the right expectations, and we'll go through this whole selling process. But taking shortcuts does not lead to a successful business brokerage practice. The last thing is it really does require there to be a dedication to business brokerage. Whether you have somebody internally or you yourself want to focus on it, doing it part-time leads to part-time results. I recommend highly that you work with somebody, whether internally hire somebody that's going to be a specialist or find a firm like ours. We can definitely help you out as far as on the business entity side of things, and we partner with a lot of commercial real estate agents so they can focus on the real estate, and we can give them finder's fees on the business and create a successful partnership to get deals done. Also, if you're going to be participating in business brokerage, I recommend that you check out the mbba.org. That's the Michigan Business Brokers Association. We have a chapter on the east side of the state and a chapter on the west side of the state. And it's a great way to meet others in the industry, whether it be bankers, attorneys, and other business brokers, to be able to collaborate and do deals. The education that you get from that is fabulous, and a membership in the MBBA also gets you and membership in the IBBA, which is a national organization that has lots of tools and resources. So let's talk a little bit first about buyers, and then we'll come back to representing sellers, because the vast majority of business brokering is done with seller representation. There's just no easy way to monetize and to work with buyers, yet you will work with a number of buyers. But it's good to understand the types of buyers, what their motivations are, and what types of buyers you're going to attract depending on the listings you're bringing to the marketplace. So the types of buyers, there are individual buyers or owner-operators, investors, that can be one person or a small group of people. There are strategic buyers, and we'll get into those, family offices, and private equity. And each of them are going to see a different value in a business. So this is where it gets a good handle on valuation and what the expectations can be. Depends on the size and what type of buyer you're going to bring to the table. We have a manufacturing firm that we're right now in the midst of closing the deal on. It's supposed to close in the next couple months. We are going through the last bits of due diligence right now. But that one was brought to the market. We actually had 3 solid offers one from an individual, one from an investor group, and one from a strategic buyer. And they all saw value differently. They all had good reasons for the offers they made, but one was a $1.8 million offer, one was a 2.9, and one was a 4.2. Now, obviously, the client wants the best results, so they're going to go for the 4.2, but there's a reason that a strategic buyer is going to see more value in that. And so, depending on the size of the group that you're representing, there's different channels to attract those types of buyers. Main Street businesses, usually those that are under 500,000, for the most part, those are going to be individual investors. Then you have groups that are in what we call the small marketplace, that 500,000 to 1.5 million, and typically, again, individual owner-operator type businesses and small investors. And then you start moving up in size, and really what you're moving up in is the available cash flow and the leverage of scaling a business with the larger groups, the small mid-market, 1.5 million to 5 million. And when I'm talking prices here, I'm talking about the value of the business entity, not including the real estate. And so 1.5 million to 5 million is usually the small mid-market, and over 5 million starts to get into the mid-market. And those open up channels to family offices, private equity, strategic buyers. It's all over the place, depending on what the goal of the seller. Some of them want to sell to somebody just like themselves so that it's run with a family mindset. Others just want to cash out for the biggest paycheck. And so knowing what types of buyers are coming in and what motivations those buyers have, because private equity is going to see a business differently than an individual owner-operator. Private equity is going to have probably more money and cash at their fingertips to be able to finance it, whereas an individual is definitely going to have to go out and get financing through a bank or other resource. So just understanding some of those buyer issues will make the process unfold for you as far as where to market it, how to market it, and so forth. So let's now go back to the seller, because that's the person that we're usually working with, is the seller. The biggest challenge, again, is just helping them understand their value. But you need to start off on, what's the reason for selling? And again, as I mentioned before, it's often because they're done, they're tired, they want to retire, they want to spend more time with family. Sometimes it's that they want to just exit out of this business to focus on another business venture. But understanding where their needs are coming from is important, because you need to make sure that they know where they're going next. If they don't, it will lead to trouble down the road, because when you get to the 11th hour, you'll see that sellers will stall or even self-sabotage a deal if they truly aren't ready to sell. The other thing that's important with understanding your seller is understanding their need for confidentiality. This is critical in our industry. Most of the time I tell people it's very similar to selling real estate, except for we don't put a sign up. We don't want your employees to know, your clients to know, or your competition to know. Otherwise, our job's easy. So it's done a lot of marketing through back channels and or through what they call blind copy, at least at first, so that you're not giving away information. Confidentiality is crucial. It does, and that's one of the reasons that there's a long sales cycle. It does lengthen out the process. We have had businesses that confidentiality didn't matter. Nobody really cares who owns the McDonald's down the street. So if you can list it without confidentiality, that this business is for sale, it does generate more activity and can lead to a speedier transaction. But it's critical, because normally you don't want anything out there that could negatively impact the business. As a case study, there was a listing that was out. It wasn't ours. It was listed by a commercial real estate agent. Great person that I know, but they had used their sources, their listing sources, and in their listing source, they were required to put in the address. So they put in the listing. They actually had a picture of the building with the sign on front, which also had the address. And then in the listing, it says, "This is a confidential listing." Well, that's not confidential if you've already given a picture of the building and the address. And in fact, that business, an employee came into the business owner's office extremely upset to learn that their business was for sale, and they had to do damage control on that. So just be careful if you're listing, if you're putting public information out there that anybody can access, addresses, pictures, and things like that, it can come back to haunt you, because that is not keeping that confidentiality that the business owner needs. So think of it, if you're selling your business and your employees know, they may quit. People don't like change, so they may look for another job. Well, if you have crucial employees leaving the company, that can lead to it not being as attractive to buy and drastically affect the price. Same with if you lose a key client, or if competition finds out about it, they can use it out in the marketplace. As well as just vendors, it can change the whole dynamic. And anything that can negatively impact the business adds risk to the deal and generally leads to lower price. The selling process. Again, being prepared in advance is crucial to leading to getting the top dollar. It's not like selling a house where you slap a new coat of paint on, fix up the bathroom, the kitchen, and now you're worth top dollar. The new coat of paint in a business is having clean financial statements, and usually it's 2 to 3 years of clean statements. You can't just change it around the day you want to sell it. Challenge is most businesses are run for paying the least amount in taxes, and I get it. Nobody likes to pay taxes. But running a business for reducing taxes versus running a business to show profitability at a maximum are at odds with each other, and neither's wrong. But when you're preparing to sell, you want to show the profitability. You want to show those things, and you need to be designing the way you run the books for those 3 years, at least 3 years, 5 years for larger companies. So that's just something to know, and data definitely is important. So as you're running your financials, if you have multiple locations or multiple divisions, having things that can be itemized out definitely helps for somebody to better understand. So those are some of the things in advance that can be done. So work with your clients, work with their CPAs to get them ready to be sold. Then we run into, as we've discussed, how do you set a price and the pricing versus valuation dilemma. All business owners, want the most that they can get for it. And in the commercial real estate world, pricing seems to be fairly simple. You figure out what a reasonable cap rate is on a building, and it helps you determine the price. Everybody wants to know what a reasonable multiple is, and we always like to say a multiple of what, because everybody looks at different numbers. Some look at top line revenue, some look at just earnings. There's also a term called seller discretionary earnings, which is taking earnings and adding back certain things. We often see people add back the wrong things or add back things, but then use a different algorithm, if you will, to calculate the value. And all of that stuff can lead to values that are just not realistic. Or as a case in point, we had a business that we worked on that was listed by someone originally it was a small business. They were listed at $600,000. Well, when we did the analysis on it, the business was only worth less than $2 million. And when we said that where their value was, it was no wonder they hadn't seen any activity on the listing previously, because they were asking $600,000 for a business that wasn't close to that in value. And so we had to explain to them where the value was driven from and look at it from a buyer's perspective on what they were going to get. It's not just straight and simple as saying, what's the multiple number, multiply this. Nobody walks into a business and says, here's a blank check, I want your business, take that number, multiply it by 3.2, fill it in the check, and we're done. There's a lot of reasons and things that are looked at. And the two biggest drivers of the value of a business is its ability to make money, cash flow, and the risk to that cash flow, especially future risk. And everything else that we can talk about usually is a modifier of those two things. And it's the risk factors that are the hardest to judge based on industry, based on just outside forces, based on current inside, how much of the revenue is tied to one client versus another client. Employee risk, that's a huge one right now with the labor market so tight. So risk is a big factor. So once a value is established, and again, we went back to that one case what is a proper value on a business. The manufacturing firm that got the 4.2 offer really comes, the valuation that we came up with was that he was worth probably somewhere in the 3 to 3.5 million range, and to expect offers between the high twos and to the upwards of the low fours, depending on the buyer. But realistically, that buyer that paid 4.2 had his bank do an analysis, and their analysis came up that the value was 3.6, and that's all they were willing to lend on. This strategic buyer saw additional synergies that they were going to be able to leverage, and that was comfortable with the premium he was paying for it. But again, understanding what that value is and then how to go to market. So that's the next step, is marketing and vetting buyers. Again, keeping confidentiality. That's the important thing. So picking a marketing strategy that ties in with that confidentiality need, that is important. And there are channels of where to list businesses. We work with several, depending on what type of buyer, whether it's a private equity or more of an individual, where we focus efforts. We also have a database that we email out to. I think it's over 30,000 right now and growing. That helps us, again, market to potential buyers all throughout the Midwest. So marketing to those buyers is important, and then bringing them in. And normally we use an NDA, a non-disclosure agreement, before any information is shared. And often our clients want to be part of that process. They may want to pick and choose who actually goes to the next level, because if it's somebody that's in competition with them, they're going to be very skeptical about sharing information, even with an NDA signed. So we work with clients to customize that process to make sure that we maintain that confidentiality. Because once the word gets out that a business is for sale, it almost always loses value at that point in time. So vetting potential buyers, this is one of the biggest jobs that we have, because if you were a business owner and you were selling the business yourself, and you're having to deal with all of the people come through, there's a thing that we call deal fatigue, and it's very real. We want our business owners to focus on running their business and keeping it growing, and having to take time out of running your business to answer questions and to even to vet buyers can be overwhelming. With that manufacturing company, we had over 100 inquiries in the first month. That would have taken a lot of time out of the day for that business owner to deal with. We also have another client right now that has been trying to sell their business, and they've been working with 4 buyers. It's a greenhouse company, a specialty greenhouse, and they've come to us now to help them through the process, because they've worked through these 4 buyers and none of them have panned out. But it has taken them away from focusing on the business and running the business, and they realize that if they do this too much more, it's going to affect their sales and their ability to run the business. So again, working with those, and then finding a buyer is only half the battle. In fact, 60% of our workload comes after a buyer's been found, in doing negotiations, working through due diligence, coordinating with attorneys, CPAs, bankers, and getting the deal all the way through close. And that's the part that I guess most of our clients don't see and don't understand, is the amount of hours that are put in after a buyer's been found. And most agents can understand that because of the workload that goes in behind the scenes after you find a buyer or a tenant for a commercial piece of property. With that, let's kind of go through some of the pitfalls that you can avoid in working with clients and in these transactions. And the mistakes, unfortunately, happen in this business, but they can be costly both to the client and to you. So we want to avoid them at all costs. And one of the biggest ones, again, is not allowing yourself enough time, or the client not allowing themselves enough time. Prepare your client on what the journey is, because it is a slow one. Even with, like I said, finding a buyer right away, it takes months to get to close. There's always a little thing that comes up. Somebody's on vacation, somebody needs to review a contract, attorneys back and forth, bankers, whether an environmental study needs to be done, all of that just delays the process and leads to more time. You need to make sure you are educated on all of the nuances, and then educate the seller on these. how to communicate with buyers. Working, with a seller, again, often sellers are they're done, they're tired, they're ready to retire. I don't know too many people that get really energized to buy a business when a seller just says, this is so much work. I'm just tired. It's just hard. I'm sick and tired of dealing with, employees complaining all the time. And so, again, case in point, don't want to have them saying that. It's okay and want them to be honest about the challenges in the business, but not have the negative attitude. So we need to get them to focus on the positives. Again, some of the detractors on valuations that buyers see, that two of the biggest ones, and this is the pitfalls to avoid, is that businesses tend to be very owner-centric. And what I mean by that is the owner is involved in everything. We always say that owners like to be, because it's great for their ego, it's horrible for value. If you're an owner or you're a business owner that's selling his company, is involved in every decision, in the hiring and firing and client decisions, it definitely detracts value, because as a buyer, that buyer is going to say, well, what value am I losing, and what's the impact if that seller leaves? The businesses that have worked hard to where the seller is less relevant and more so irrelevant to the day-to-day operations makes it more valuable, having a management team and a business that can run on its own. The other, we call them concentration issues. Are there over concentration in the clients they serve? If they have clients that 2 or 3 of their clients are more than 50% of their business, that's a huge risk if any of those leave the business. As well as concentrations in vendors. If you get all your supply from one place, and we're seeing that right now with supply chain issues, if you're getting all your stuff from one vendor, that can lead to challenges. And so the more you can diversify where you get things. Concentration in industry. If you are a small tool and die shop, and most small manufacturers that serviced the automotive industry learned their lesson years ago that they can't service all clients just in that industry, because they live and die by the automotive industry. As the industry is expanding, they're doing well, and when it's contracting, business is drying up. So a lot of manufacturers have figured out how to service other industries so they're less industry dependent. And concentrations on employees. And that's the biggest challenge right now, is cross-training and having enough overlap so if you lost a key employee, it would not be detrimental to your business. Again, working in confidentiality and helping the clients understand the importance of that and not breaching their own confidentiality. I had a business just the other day, great restaurant, and we don't do a whole lot of restaurants just because they're not as profitable as they think they are. But this restaurant was doing $5 million, had 2 locations, great restaurant, run really well, and he's just starting to look into potentially selling his business. Well, no more than a week later, I heard from 2 separate sources that his business was for sale. I reached out to my friend and said, hey, I'm hearing that you're actually for sale. And he just said, I don't know who would be saying that. I haven't even decided if I'm gonna or not gonna. And I just said, well, you need to be careful who you're talking to, and make them all understand, because a lot of times they're talking to their attorney or their CPA, or just somebody who's always been critical in their business decision process. And people like to talk. If it's a great name, they like to talk about it. And if they don't understand that this is needing to be confidential and cannot be shared, I would definitely have clients, if they're going to talk with anybody, have them sign an NDA, even if they're not signing it because they're looking to purchase it. And so we see that all the time where confidentiality gets broken. Or if the marketing strategy is where you're actively reaching out to people and talking to them about, would you like to buy a company in this industry? Well, you got to be careful on outbound strategies, because people, again, if they're not interested, that curiosity, they like to start to whittle it down. And if you're one of 3 specific manufacturers in widgets, and you start talking to the other 2, they're going to figure out the 3rd one's for sale. And again, that can lead to a downturn. The not planning for what's next. We had a business, it was an automotive repair. We told him what he would probably get in the marketplace in a range. It took 18 months to get the right deal because he was very specific on the type of buyer he wanted, but got him a full price offer. And then in the 11th hour, after attorneys have written all the documents and they're basically got all the financing done with the banks and ready to set a closing date, the guy pulled out. The seller pulled the plug because he just was not ready to retire. He got everything he was planning to get from a monetary standpoint and realized he just didn't want to not be going into work every day. And so the deal fell through at the last minute. So that it is important to really understand and make sure that they know what they're going to do next. And then having business owners understand how the transition works and what's going to be expected of them. Knowing what involvement they're going to need and what deal structures might be important to that. So those things we can get into a deeper discussion on if you have questions. Focus on running the business. Again, that's the biggest one is we need owners not to be, I get all the time, I want to sell my business and it's like, how soon can this be done? I'm ready to move to Florida and buy a boat and be fishing. They need to be focused as if the business isn't going to be sold ever and running the business as if they're going to have it for the next 10 years. And then when the transaction happens, then they can move off to Florida and get the boat. So, again, on the understanding of confidentiality for you, the agent, you need to know what channels, how to use those channels. We do a couple different strategies. Inbound, that's using listing services and our email blasts. Great way to actually get the listings out in a confidential manner because you can keep it very generic. Outbound marketing tends to get more risky for confidentiality, and so it just depends on if there's a need for that or not. Not being realistic on setting the selling price. I was working with a commercial agent over in the Detroit area, and they have had challenges in the past because they've always been very successful in commercial real estate, but not widely successful in trying to help people with their business. And the reason being is they've always asked the owner what they think the price is, and the owner says, well, $2 million, and that's the price that they market it at. It sets a false sense of entitlement for that business owner, thinking that, well, if it got listed at $2 million, it must be worth $2 million. And that's a challenge. We had a business owner want to list their company at around $1 million and said, well, that's what these others are selling for, because he knew and it was a restaurant. And these others that were listed around that same price had been on the market for 2 years. So they're not selling for that, they're listed at that, but they hadn't been transacting, yet this other business thought he could get $1 million because everybody was listed for that, yet none of them had been selling. Next pitfall, focusing only on price or needing an all-cash offer. In our arena, deal structure matters. In fact, more so than just the price. Sometimes we need to help those clients understand that because it's beneficial to them to look at other structures from a tax perspective. And this is where working with their CPA or their financial advisor can help. But all cash offers sometimes aren't going to happen in specific industries. So we need to have business owners understand what might be a likely path for them so that they're ready for it. We had a business that was a commercial cleaning company that their attorney and CPA said, nope, don't sell unless you get an all-cash offer. We had 3 offers come through that were very generous and sizable, and the deal never went through because they weren't all cash. They needed to have some of it backed by that owner and financed because they needed to make sure all the accounts transferred over, and that was their leverage to keep accounts on the books. And so not having that can be detrimental to the deal. Not having quality updated financials and being able to understand all of those financials because you need to be able to explain that or defend that to a buyer. We had somebody list a business up north. I had a buyer that was willing to pay a fair price, whatever that price. Buyer was qualified for anywhere up to $2 million on this type of business, and they wanted $1.5 million. But when we ran the analysis, the business was only worth about $800,000, and we were happy to pay more if they could show us how they got to more. And the reason came down to that's what my client wants. And it's unfortunate because the deal never happened. And 2 years later, that business actually ended up just closing the doors. And then understanding that this is a team sport, and having the right team. Having your clients understand that, having the right CPA that understands business transactions and the consequences to that. Having an attorney that has worked in the transactional space. And then, working with their financial planner, working with the banker, business brokers, commercial real estate agents. There's all different nuances to the transaction, and everybody has a place at the table, and bringing the right team together will lead to more successes. Another pitfall just to be careful on is working with buyers and not properly vetting them. Again, don't want to have too many buyers going through and taking visits at the company if they're just looky-loos, making sure they're financially qualified, making sure they understand the opportunity so that they are the right fit. So you're only bringing a handful through. And then understanding the need for the NDA and working through that and not giving away information, because if you let people know information before they've signed the NDA, if they start to share it on the open market, there's really no recourse. Again, working on and understanding different types of the variety of offers that can and or might be encountered. In our world, there is no set way. Everybody says, well, what's standard in this? What really happens? Everything's on the table. Again, this doesn't fit into a cookie cutter approach as far as how things are sold. The buyers can ask for anything. The sellers can ask for anything. It can be structured in a number of different ways. And we always get it where people say, I don't want to be in a structured deal. I just want all cash. Yet, I want to sell for $1 million, but if somebody gave me $800,000 in cash, I'd be out. Well, what if somebody gave you $1 million offer but asked you to finance 20%? Oh no, don't want to do that. They're still going to get $800,000 up front, and then potentially $200,000 down the road. Again, there may be reasons not to, but that's awfully attractive if they were going to just take $800,000 cash offer, and getting them to understand that. And I always like to take it to an extreme on that as far as deal structure. I'll pay you whatever you want for your business. You want 10 million, 100 million, as long as I get to pick the deal structure. So if you say $10 million for your, even if that's way overpriced, fine. I'll pay you $1 a year until you're paid off. Obviously that's absurd, but that's where structure does matter and actually trumps just price alone. Price is part of the structure, but structure in and of itself is something to be aware of. Whether there's financing from the seller, how much the buyer's going to come down with, whether there needs to be bank financed. We don't ever recommend somebody do this on the proverbial land contract where the business is being paid for out of the proceeds of the business. There needs to be skin in the game from the buyer, but that is definitely something that can help. And now, since we're doing this virtually and I don't have the live audience, I'm going to address some common questions we get when working and collaborating with commercial real estate agents. So one of the questions that we get asked about from commercial agents is, can a commercial agent be successful in this arena, partnering up with a business broker like ourselves, and without needing really the in-depth knowledge on business brokering? And the answer is absolutely. Basically, again, where the commonality of our business models, it's a relationship business. So if you have a relationship with a business owner and you have their trust, we're all working as trusted advisors. If you have their trust, you can be very successful by bringing them to the right avenues to create a successful transition. Again, if you're not focused on business brokering within your office, I would recommend having a quality business broker where you can share in the revenue and get the deal done the right way and as efficiently as possible. Another question that always comes up when we partner with commercial agents is, what's in it for me? Everybody wants to know on the compensation. And as mentioned, compensation in the business brokerage world tends to be higher on scale than just commercial buildings and property. I know in the property world and commercial buildings, it usually ranges somewhere in that 6 to 8% range. And in the business broker world, it typically depends on the size of the deal, but can be as much as 10% and does come down on the larger deals in the 4 to 6% range. But generally speaking, it's somewhere 6 to 10%. And when we partner with commercial brokers, it just depends on the total deal and the amount of workload being done. Often we're not taking a piece of the commission generated on the real estate, and we're sharing in the commissions generated on the business brokerage. And that works out to be widely successful in not having to build up the channel yourself and have access to all of the marketing oomph that we bring to the table. I've often been asked how much time is actually involved in a project, and it really does vary depending on the size and honestly the confidentiality needs, because again, as it's more confidential, it just lengthens out the process and more steps. But typically, most of our projects are 200 to 400 man hours from the time that we're first engaged with the client, addressing and assessing the prospect and getting realistic listing expectations all the way through closing. And it can be a lot faster, and I don't like to put timetables on it because then clients want to pay us according to time, and it's not about the time invested. Sometimes we're very underpaid for the time we put in, and often we're overpaid for the time put in, but we're being paid for the expertise in getting a deal done. Whether it's a single party listing where we already have a buyer that's looking for a specific type of listing and we bring it to the table and get it done. There was a lot of investment in time in building up those relationships in years past that weren't directly related to this client, but were needed. And so how do you address those timetables? But back to the question of how much time. It is time consuming just because we are the quarterback trying to get all the parties to talk to each other. The biggest threat to a deal is when momentum stops. Momentum is important, and that's our biggest job. Once a buyer's been found and they've signed a letter of intent, is keeping the momentum going. Whether it's on the sell side, sometimes it's seller issues that we have to overcome to keep the momentum going, or on the buy side. But once momentum stops, then the other party tends to get cold feet. And as long as deals are moving forward, sometimes slowly, but as long as they're moving forward, everybody's happy. As soon as it stops, people go into panic mode, and we've seen deals actually blow up because of just the momentum being stopped. So we've talked a lot here about whether to specialize in business brokering or collaborate. And knowing what the characteristics are and needed, and the skill set needed to be able to do business brokerage as a specialty or to hire somebody within your office to do that. You do need to have a good handle on how to analyze a profit and loss statement, balance sheet, and the internal financials and workings of a business. You also need to be able to have some semblance of industry knowledge. If you want to specialize in an industry, I have a teammate that only does pharmacy transactions, and so he understands that world very, very well. Some industries require more industry knowledge to be able to work through the deal on both the sell and the buy side, and others less so. But if you want to specialize in an industry, it helps to understand what their challenges are, how they operate, and so that takes some time in just getting educated. Another skill set that's definitely needed is being able to do valuations. You can analyze profit and loss and look at what things might be good, but if you don't have a tool, then you're going to definitely need to have an outside resource that can help you assess value. Because if you start with the wrong valuation and the wrong expectations, it's not going to be successful. So I definitely recommend you either have an external resource or take time to get educated and trained in valuation. All too often we see, whether it be other commercial agents or even business brokers, just take a rough rule of thumb and apply a number to it. And that may work, but it doesn't make you successful in the long run for getting larger and larger deals. So often we're asked, what makes an ideal seller? And to be honest with you, I don't know that there is one. The best seller, obviously, as we've talked, is somebody who wants to plan in advance. With advanced planning, they're going to be able to find the best path, whether it's selling or transitioning to somebody internally or some kind of other exit strategy that's out there. Unfortunately, most business owners don't plan in advance, and then their best exit strategy ends up being either liquidation, which is usually not the highest dollar amount, or selling the business on the open market. I get people all the time that say, hey, if I ever hear of a business that wants to sell, I'll let them know about you. And I always say, thanks, that's great. But honestly, that's not a great referral because it's already too late. Working with businesses at least a year in advance, knowing that it's going to take 6 to 18 months once it's listed, so getting them prepared in advance is important. And so I really want to work with, and you should want to work with, business owners who own a family-owned business that are in their late 50s, 60s, 70s, and we just sold one where the person was in their 80s. All of them should be talking about what their exit is, because unfortunately that exit may be thrust upon them from that health issue, a downturn, or gosh forbid we have one right now out in California where it's being sold because the owner died. And now they're just looking to get whatever they can get out of the business, and that's definitely not a great plan. So we often see red flags, and I want to give you a little insight to that with clients that might not be worth taking on. And those red flags can include if somebody's very price conscious, especially they want to negotiate commissions ahead of time way down. There's reasons to discount things down for various, or there's various reasons to be able to offer a discount to clients. But when somebody is super price conscious, whether the value that they're just not realistic in it and they keep fighting to have it listed for twice what you think it's worth, and you end up taking it, they're usually a headache all throughout. The one that wants to beat you up on commission at the front end, well, when the deal finally gets ready to go to close, we'll try to say, well, I don't want to do this unless you'll discount that commission further, because the commissions are quite substantial, but you're worth it. Another red flag that we have seen is when somebody's had their business on the market with another agent at a price, again, that's well above what the valuation is suggesting. They're already going to have unrealistic expectations that they can get that higher price, and they're probably not going to lead to close. Another way that we've been able to identify clients that could be a challenge to help get all the way through close is we typically charge a setup fee to get them ready to market. It's very small, but when we have found that clients have balked at that and not wanted to pay anything up front, they only want to pay something if and when it's sold, i.e. test the marketplace, we have found that they are usually not ready, or there's going to be challenges down the road. There may be reasons to waive that or discount that setup fee, but 9 times out of 10, the clients that have put up resistance to that have not been quality clients. And so that's just something that we've used to gauge whether somebody's ready or able to go through the process. So with that, this is normally, and the challenge with doing these online webinars is that there's no audience to ask questions along the way. I am happy to address any questions or concerns that you might have in working either together or just in getting started in this industry. I welcome more people to become full-time business brokers. Competition in this industry, it's a very underserved industry. We need quality people doing quality work. If it's something that fits your business, but you just want to have a resource to be able to collaborate with, we're happy to work with real estate agents on working together on the business entity, and then having you work on the real estate and keep that within your office. So just let me know. My name and number are on the flyers that were handed out, as well as here on the screen. So please feel free to give me a call. The number is my cell phone. You can text or leave me a message, and email's fine. Normally, I will get back to you within 24 to 48 hours, depending on the urgency. So just let me know how I can be a resource for you and how I can help. Again, please, if you're going to be in this industry, look at joining the MBBA. It's very affordable, and there's lots of great resources there. We have, like I said, a chapter in Metro Detroit, and then one over in Grand Rapids. So thank you very much, and look forward to hearing from you.